Great conversation. We're going to be changing it up. We're going to be talking about different strategies because guess what? I know I hate to say this, but multifamily is actually not the only real estate investing strategy you guys can take on into your business, and not even the only residential strategy you guys could take on. So we're going to be bringing my fellow host of the Best Ever CRE show, Amanda Cruz, up now to join me up on stage. Come on up, Amanda. Give a round of applause. Give it up. Give it up for Amanda.
What's up, Ed? How's it going? Good to see you.
Sue, how's your conference going so far?
Dude, it's always a fun time at Best Ever.
I know.
Such good friends.
Yes.
I don't know how many people were out a little late last night. I don't know. I checked out at 9. How about you?
Yeah, I knew I had to behave myself and be doing a VIP breakfast at 7:15 this morning, so I did not go last night.
Oh, you skipped the whole thing.
Yeah, I stayed in lower gears yesterday. So did you enjoy the Best Ever party last night?
Yeah, I
How
went
was
for a
it?
while. I'm on East Coast time, though, so that was a little late for me, but it was fun. It was
Yeah,
a good
I
time.
like traveling West Coast on East Coast time because it's just automatically you get tired when you're supposed to.
Heck yeah.
we're good.
I woke
We're
up at
good.
4:45 yesterday. I was like getting a million things done.
Well, I hope you're having a good Best Ever as I am as well. I'm not sure if I'm having more fun up here this year or out there. I'm just not sure. They're both a lot of fun. And is your Best Ever going well too? Aside from the Best Ever party, you making some good content?
Absolutely. We have a good group here. I feel like the group that's here this year, they're really serious. I love it.
It's
No
hardcore,
fluff.
man. It is. They
Heck
only
yeah.
laugh at some of my jokes.
Fair enough.
See, they didn't
fair
laugh at
enough.
that. You see that? Yeah, cool. Got it.
It's a
All
tough
right.
group.
It's got you. I got you. But they're here to get things done. So, what I want you to do is tell us a little bit what you've got in store coming up for this panel coming up.
Oh, dude, Matt, we have 4 really awesome, heavily experienced investors in different niche residential asset classes, not multifamily.
I know. It's all right.
So if you
I
guys,
accept your terms. It's
I
fine.
hear it, either actively or passively, if 2026 might be your year to find a different asset class, but maybe you're not willing to join Ash Patel in office and jump quite off the deep end, this is the panel for you, okay?
Okay, it's a
Sticking with
little bit
residential.
over. I don't know if I can accept the Ash Patel thing, but a little bit, one step away from multifamily, I'll meet you there. No.
Yeah, one step. We're
Okay,
not asking
one
you to
step.
go by office.
Just one. Cool. All right, guys, give it a round for Amanda and her panel today. I can't wait to hear what you're going to be talking about for alternative strategies for residential housing. Round of applause, guys.
All right, let's do it. Let's bring out the guys. Let's go. Good to see you. Thank you for joining. Good to see you. Dude, can we follow instructions? Man. All right, so it's true. You take a group of entrepreneurs and they can't follow one minor instruction. What the hell? All right.
We got a surprise for you.
We're off to a good start.
Oh, well, I already told these guys. I threw out any question we might have thought of. I just emailed their wives instead. So this is going to get to be a super fun panel. Their wives informed all the questions for us. Chris, I'll pick on you first. Chris Larsen, president of Haven Senior Living. You've done a lot of different residential.
We have.
Now you're in senior living. For those of us not super experienced in that asset class, break it down for us. What are the buckets of senior housing?
Yeah, so I think, first off, thanks for having me. I think senior housing is really a different flavor of multifamily. And I spent my professional career in medical device. I got into that because of demographics. I got into multifamily 12, 15 years ago because of demographics. And we're about to see this wave in senior housing. The first baby boomer turns 80 this year. And that's typically about when individuals move into specifically assisted living. So a lot of people think like nursing homes. So when you think senior housing, you have independent living, which is going to be 55 plus. So you could take an apartment community and turn that into a 55 plus community. A lot of people have those in their neighborhoods. Then you have assisted living, which actually my stepfather is in. He has dementia. And assisted living is going to help those that have a deficiency in what they call an activity of daily living, an ADL. So it's going to provide, meals, help bathing, cleaning, laundry, those sorts of things. You then have memory care. So typically you're going to have independent living, assisted living, and memory care. Then you get into skilled nursing. That's what really nursing homes are. That's a whole different ballgame. But the big difference in senior living and senior housing is you have these different levels, and we're used to different payer mixes in multifamily. You know, you have subsidized housing. You also have that in senior housing as well. But a lot of people get confused. They think Medicare will pay. It's actually Medicaid. So there's a lot of different regulatory issues there. And then if you wrap it all together, you can have what are called continuing care retirement communities, and they have all three: independent living, assisted living, and memory care all in one.
Dude, Chris, good for you. I found that hard to even keep up with all the different asset classes, and good for you. All right. Craig Curelop, I'm going to pick on you next.
Going out of order.
Founder of the FI team, broker, you came up house hacking, now you're focused on co-living. Explain to us, what is co-living, and why the heck is there so much buzz around it right now?
Yeah, so co-living is this type of asset where, I mean, we're buying like large single-family homes or even some multifamily, and instead of renting it out per unit, we're renting it by the room. This, creates this like win-win-win scenario where the residents or tenants, we call them residents, are winning because they get a really nice place to live in a really nice neighborhood for like half the price as a one-bedroom apartment. The landlords and us investors are winning because we're able to get about twice the rent as we would as a single family. And then honestly, the municipalities are loving it. Like, we feel like there's a tailwind with the municipalities because we can increase density in about 2 weeks. So when you're creating this win-win-win scenario, I just feel like it's an amazing asset to get into. And there's so much blue ocean right now where, I mean, I can go into any room and almost all the time I'm the only co-living guy there. And so it's like I find all my deals right on the MLS, right? And they're fantastic deals.
We will get back to that. That is wild. Derek Petersen, Aviara Capital Group, you're based in San Diego. You are doing accessory dwelling units now, but you have 30 years of ground-up construction, multifamily experience. Talk about the types of projects you do with ADUs.
Yeah, so we're complete. First of all, thanks, Best Ever, for inviting us up here. That's great, talking about what we're specifically doing in our own markets. I look for multifamily, and specifically in San Diego, I'm looking for 8 units and greater. The reason for that is now with California's ADU laws, they allow us to build a separate detached ADU structure of 8 units, up to 8 units. And it matches whatever's the existing apartment. So if you have a 5-unit, you can only build 5 units. And then you can also build out garages called uninhabitable space within the existing apartment building up to 25%. So if you have an 8-unit building, you've got 2 units that you get to add there, and then you've got a separate 8-unit structure that you're adding. So realistically, you can take an 8-unit building and you can finish with 18 units. And in our market, our doors are going for $350,000 to $400,000. I look for areas that high land value, square footage value is extremely high. I want to get paid a lot for building. And I can build micro units. My last project, I was able to add what I consider almost micro units because they're 275 square feet, close to campus, and that cost me, that project, it was about $80,000 a door, and those are going to be worth maybe $300,000 a door when I'm done, which I'm already done. Okay.
That's cool. So Ash and I interviewed you, and I think it's really interesting. A lot of times you think of ADU, and it's like one single family house, an ADU in the back. And you're sort of mixing in multifamily with building ADUs. It's a really cool dynamic you have. Alan Underwood, Momentum Capital Groups, you're out of Phoenix, but you're also doing ADUs in San Diego. You have tons of experience starting and scaling and exiting businesses. What did you initially see that got you excited about scaling ADUs?
Yeah, so like I talked about yesterday, the 3 Ps for me of investing is what is the problem that's being solved, what is the process that's solving that problem, and who are the people that you're involved with. And the problem is easy to identify, is you have a huge housing deficit. There's no way that the city can issue enough permits or builders can build enough units to keep up with it. And you also have a very unique investing market, and I think Derek would agree with this, is you have a perfect climate year-round. You have billions of dollars in tourism. It's the most important military city, which brings not only military personnel, but also all of the businesses that support that complex. Cross-border trade with Mexico. So there's a really unique economic environment there. And I really liked that, and the problem that it caused with housing was one that needs to be solved. And then I met a great partner, so this is skipping to that third P, that his family had 40 years of experience developing in San Diego. He was a top 1% broker. He was already managing 300 units. And I saw him buy a house for $900,000, put down $50,000, get construction finance, add 2 additional units that cost him about $350,000 in debt, and then that property 15 months later reappraised for 2.25. So in a little more than a year, he added $1 million of equity to his personal portfolio. And for me, that was mind-blowing. I was flipping houses in Phoenix, and it was a great day if you could make $50,000 or $100,000. And honestly, I thought he was lying to me with the numbers. So I have a degree in accounting, and I went and audited what he was doing, and I was just so impressed. And at that point, I just had one question: is like, are you accepting money? Why aren't you bringing money to this? And he said, well, I don't have time. I'm too busy doing what I do, and I don't know how to do that. And I thought, well, I'm willing to make the time, and I know how to do that.
Oh, love that.
That's where we started working together.
Craig, talk to us about the strategy of co-living. A lot of us in here consider ourselves value-add investors. We want to buy something. We want to force the appreciation. What is co-living? Is it cash flow, value-add, what?
I would say the best advantage to co-living is the cash flow. I mean, so if you want to do a value add, you can kind of combine a value add with co-living, and we've done that, where you buy a distressed property. It just needs to have a big enough footprint. And you buy it distressed, you get it to be like a 5-bed, 3-bath, or a 6-bed, 3-bath, so something that's comparable to what's on the market. You can then refinance it, get back some or all of your money, and then of course, with the money you get back, you can then go ahead and add the 5, maybe 3 or 4 more bedrooms. Ideally, we like to be between like an 8 and 10 beds for a house. And again, we're seeing, about 2x on rent. On any given thing. And of course, like from a value perspective, like you're actually probably devaluing the house, right? By putting more bedrooms in. So the way that we construct the walls, and some people even put up temporary walls, is like we can very easily take those walls down with very minimal damage. Might cost an extra couple grand, but that's like 1 month's worth of additional rent if we ever wanted to resell it. So it's pretty easy to put it back.
Got it. So you're not necessarily adding a bunch of value to the home. You're getting a ton of cash flow though.
Yep.
How are you financing these?
What's that?
How are you financing?
We've been financing just straight with DSCR loans for now. Many times they need to work as like a long-term or like an STR, because a lot of guys aren't. I mean, almost no one that I know is like lending strictly on co-living yet. Or we also can run this master lease scenario, which some lenders take, some lenders don't.
All right. Can you scale this model with a bunch of single-family houses and DSCR loans?
I've got colleagues or friends, I guess I know, that they've got 4,000, 5,000 rooms across multiple markets. So it's for sure scalable. I think where the scale comes from is not necessarily picking up one home at a time, but it's picking up like a portfolio of homes, or in bigger markets, probably like San Diego, we could probably take a larger multifamily building and rent it by the room, and we may not get double each one, but if we can get like $400 more per unit times 40 units, I mean, that's adding real.
Let's do that.
Dude, I like that strategy, yeah. I don't think anyone's doing that, Craig. All right.
Yeah.
Craig and Derek are partnering. Anybody else coming along?
Yeah, I'm in.
Sweet.
It sounds very operationally intense when you say thousands of single-family houses. Now, I'm a mobile home park operator. I know all about operationally intense assets. Chris, I know senior living, operationally intense too.
Yes.
For active and passive investors in the room, what should they be aware of because of the operational complexities?
Yeah, and I think mobile home parks, which we have 20 as well, with our partner, or that's a good analogy or good comparison, because if you got a bad operator in the senior housing space, you're not going to do well. And I was talking to a friend about an hour ago, and he said, yeah, it's basically like you're running a staffing company. As a percentage of expenses, you're looking at 30, sometimes even as high as 40% of your expenses is going to be your labor. Now, that being said, I think there's a lot of opportunity with AI and robotics, specifically in senior housing because of wearable technology. You have in-room Wi-Fi that can act as like radar to determine if patients or residents are moving around when they shouldn't be and doing those things. But the other thing is, and again, this is another analogy I think you and I spoke about with mobile homes, is that it's very similar. You've got a lot of small operators. So where multifamily you have 75, 80+% is institutionally owned, it's the inverse in senior housing. So again, that's an opportunity, but if you're coming in, I've got a friend, for instance, in Asheville, North Carolina, where I'm from, and he bought an assisted living facility. He partnered with an individual who's going to operate the space, and they're at 30% occupancy right now, and he wants to get rid of it, and he can't. So if you're an active operator and you go out, you've got to be very, very selective with who your operating partner is, and it's the same thing for passive investors as well.
Alan, a lot of markets across the US have experienced declines in asset values. And that's also true in Southern California. How has that impacted your business plans for ADUs?
I think the overall business plan hasn't changed dramatically. It changes the result. A bigger impact is timing, and it's different. We've now gone 3 different funds, and the first fund we had a difficult relationship with an architect that delayed the design and permitting, and that was far more costly than any change in the market. I mean, historically, the San Diego market, one of the reasons why I like investing there is, in fact, we participated in a study with USD, and they looked at San Diego over the last 30 years, and even during the dip from 07 beginning then and later, it was a much less of a dip in the San Diego area, and it recovered a lot quicker. And so we haven't seen as big an impact on that side. I think bigger is operationally, we had a difficult partner that delayed us, and that time delay was far more costly than what the market has been doing right now. And that puts pressure on those first investments that we made. Fortunately, we learned that lesson and changed partners, and the other ones are performing much better. Like, we're getting permits 3 or 4 times as fast as what we were experiencing, and that changes the whole game. Those will be better than we projected. The other ones won't be as good as we projected.
Thank you for sharing that. And how are you handling conversations? There's a lot of that going on right now in general.
Yeah.
How are you handling the conversations where it's, hey, here's what happened, it impacted timing, and it's not going as well as expected?
Obviously, each of those conversations is different because everyone invested for a different reason. But I think the underlying thing is, if I look across everybody that's invested, it comes down to they invested with people, and they want to be treated as if they matter, not just their money. And you can go a long way by being anticipatory in these conversations. And so some of our investors, I have one that's a good friend of mine, he's a pilot. It was one of our very first investors. We have a great relationship. He invited some other friends. And with him, I have a call every single month that goes deeper than maybe what we're sending out an email. And I have other investors that they've never opened an email. They don't respond to text message. If I call, they don't want to meet. They just, when everything wraps up, we'll sort it out then. So you have to know the people that invested with you, and you have to be willing to understand that they've trusted you with a lot. It's not just their money, it's maybe years of work, and for some people it might be their first deal. For others, we have a family office that invested, and we're just a part of the portfolio. And so with each of those, I think the thing is be honest, be quick to communicate, and when things are going wrong or not as planned, don't hide that. That will do more damage than anything else. I think people can tolerate sometimes if things don't go as well. What they can't tolerate is when they feel like you're not communicating, you're not being honest.
Heck yeah, well said. Derek, California isn't necessarily known for ease of construction or getting anything done, really. How does that impact your builds?
How much time do you have?
Like 10 seconds, good luck.
10 seconds. So real quick, so in California, if you're building multi-unit, obviously you go through the discretionary permit process, CEQA, all that stuff. It's probably going to push you 5 to 7 years to get anything out of the ground in California, really. The ADU laws are basically a ministerial permit. So what that means is the local agencies are mandated to allow us to build, because there is a housing shortage, right? So Sacramento and the local agencies are kind of at odds a little bit. So there's a lot of NIMBYism in the local agency level, and the state wants housing. So for the most part, the ministerial process is mandated to take 60 days. 60 to 90 days for an approval. So, I mean, that can bleed into 6 months, but still, 6 months compared to 5 to 7 years. And then on top of that, this is kind of new, so as a civil engineer, I'm used to navigating the local agency process. So I have a little bit of an unfair advantage that if you were to just go into the San Diego market and try to pull it off, you might be able to pull it off. But it's a little bit easier probably for me because, and then if you have a local agency that's not playing ball, you've got a number in Sacramento that you can call where they'll place a call to the local agency saying, this development fits in the box. What's the problem, guys? So it's really a unique time that we're in right now, and it's Wild West.
I like it.
ADUs
You have
out
an
there.
ADU fast lane.
It is,
Right.
absolutely.
Skirting right around. Craig, co-living has been growing at 13% annually, and it's expected to keep doing that through the rest of this decade. We all saw the pre-COVID Airbnb rise, and then the Airbnb reckoning. Is co-living the next Airbnb?
We like to kind of compare it to Airbnb, but I don't think it's going to nearly has as high of a high or as low of a low. And the reason for that is Airbnb is really sexy. Like, you can have a really nice place in a really nice location and like show that off to your friends. And maybe us very logical people here in this room don't think like that, but a lot of people who are on Airbnb do. And so there's not really that component. Like co-living, if you go into a co-living house, it is not sexy. It is a house with a bunch of walls, and everything is super basic. So there's no like sexy component. There's also really no use case for it. Like, a lot of people buy these Airbnbs so that they can have a secondary home and justify it. I think where a lot of people got in trouble with Airbnb is they kind of went half in. Like, I've got some good friends. I mean, one of my good buddies here, Mike Brockway, I think he'll be on stage later. He runs a fantastic Airbnb business. He was doing Airbnb before, during, and after. And he's still doing great because that's his business. The people that are kind of half in the door aren't going to make it. So we're really trying to like iterate, get things really good, make sure the residents, we always come from the perspective of like, we need to make sure the residents are super happy. And so all of our systems are making sure the residents are super happy. That's actually very difficult to do. And so I know we'll survive it all, and I think in a couple of years there'll be a lot more co-living deals that we'll be able to pick up from failed co-living investors.
Heck yeah. And by the way, if anybody's considering an Airbnb just so you can have a second place to go visit, that is a really dumb idea. Do not do that. And if you want to talk about why, I'm happy to share my thoughts. We successfully convinced one guy yesterday whose wife told him don't do it, and he really wanted to, but luckily Paulette here and I were like, this is a really stupid idea. We told him 5 reasons, and he's like, all right, fine, my wife was actually right. Alan, you do really well with lifestyle design first, but you started scaling first, and then you were like, oh crap, maybe I made a mistake. Can you tell the story?
Yeah, so this actually is really recent. So we were in our third capital raise. I had about $1.5 million left to go, and I had some of those investors already had signed, and we're just waiting for funding. And we're looking at our annual planning, and my business partner is 30. He can work like a 30-year-old. I'll be 50. I work like a 50-year-old. And which means I'd rather spend more time with my kids and my grandkids. I've already had the adventure of doing
Grandkids? Man.
200% increase last year in grandkids. We're doing well in the Underwood family. And so we sat down for our annual goals, and he has billion-dollar dreams. He wants to have $1 billion under management, and that's the ride he wants. And so I was like, okay, I think we can probably raise 20 million this year. We can get to 50 projects. We're going to have to grow the construction team. We're also going to need more property management. So it's like 4 businesses at the same time. And we got done that night, and there's a lot of enthusiasm, and I think honestly a lot of ego. Like, yeah, we're going to have that $1 billion thing. And then that night I was thinking about it. I'm like, what is that actually going to look like for me? And the next morning I came back and I said, hey, I want to revisit this. When we started working together, everything that you were doing was long-term hold. The primary plan on these particular properties is shorter term. And at the end of it, you're not going to own anything more. I'm not going to own anything more, but we will have made some money. And I said, I'm not sure that that's where I want to go over the next 10 years, and I'd like to revisit that. So as we sat and talked about it, we realized if we did 4 projects a year, not 20, that we could do that primarily with a few select investors or partners, and that over the course of 10 years, just doing 4 to 5 projects a year, the end result would be $100 million in owned assets in San Diego. And as we looked at that, I thought, man, that's going to allow for a lot more travel. It's going to allow me to do what I really love, which I'm good at real estate and business. What I really love is building people and helping other people succeed. And that's where I want to focus my energy, my effort. That's the impact I want to make in the world. The difficult side of that is if you're not raising money, not buying property, not developing, well, any potential fees that you have from any of those activities I knew was going to go away. And so talk about some difficult conversations. I called some people that had invested with us, and I said, hey, we've decided to close this raise early. And here's the reason why. I will have some other opportunities for you in the future. But for right now, we've made a decision that's going to move us in alignment with where we want to go long term. And ultimately, we believe that's going to be better for our partner investors because we're going to be rowing in the same direction. But that also meant that income went to zero, so we had to change a lot of other things to make that adjustment. But I think short-term sacrifices always will yield long-term gains, and that's the game that I want to play.
Hell yeah, thank you for sharing that. So many investors, they want to scale and grow just to show other people that they're scaling and growing, but not necessarily that that's going to be the lifestyle that they want. So even if you're already down the road, it doesn't mean you can't stop, pause, consider what you want, and pivot.
Yeah.
Chris, what are your thoughts on buying existing senior housing versus conversions versus ground up?
Yeah, so I think the need is going to be so great. I was at the National Senior Housing meeting in September last year, and the number one need is just capital. Current construction is only going to supply about 25% of the need in senior housing for the remainder of this decade. So we're facing, coming out of COVID, just a huge gap in terms of supply and demand. It's massive. It's almost, again, like, talking about being an accountant and being like, oh, these numbers are too good, it doesn't make sense. There's opportunities everywhere. You can build from the ground up. It is more challenging from a cost perspective because of cost to construct and cost of capital today. There, as I mentioned, from the mom and pops, we're seeing a lot of opportunities specifically in secondary markets and kind of what you would call that Class B space in senior housing to buy and put minimal improvements in where you can improve the quality of the property, but also the quality of the care for the residents, which is really the most important thing. And if you're selective and you can go into those communities and those properties, that's where a lot of the opportunity is with respect to that. But I think it also depends on the community. So one of the cities in Texas that we have an LOI on a property right now, there's an assisted living facility. There's no memory care within 40 miles. So in that circumstance, there's an opportunity to purchase an existing assisted living facility and then build up like a sister memory care facility, and you can really pull the two together. And there are other communities where they need everything. So there's really, you can be selective, and I think the key is really to determine, do the financials make sense for those?
How are you doing the market research for that? Just look online and see what's available?
Well, that's an excellent question. So we've overlaid, so a lot of the same metrics that we use for multifamily apply to senior housing. And really, you want to move where, if you think about senior housing, so I mentioned my stepfather earlier. So the client is really me. I'm the one that's selecting. My stepfather lives near me. Sure. So what's happening is parents are going to end up living near their children. And the children will be making those decisions in conjunction with their parents typically. So you're gonna overlay in-migration numbers with, again, 65 plus age group, or you could forward or reverse lag 80-year-old movement patterns with respect to that. And we also overlay things like opportunity zones as well. So if you're building from the ground up, that can be a very powerful multiplier.
Interesting. All right, Craig, you're buying stuff right off the MLS, but you're paying much less than the market rate, right?
Sometimes. Now the market is a little softer than it was, but we could pay over market if we had to, and the deals will still work.
All right, so you're going into the MLS, you're finding stuff, and you can pay their asking price. That sounds way too good to be true for most people in this room who spend a lot of time trying to find our assets. What are the grenades to watch out for if somebody's new, looking actively to get in and purchase something? You don't want to just buy any home on the MLS, right?
No, I mean, you want to make sure the layout works, and that's the biggest thing, is like the layout and kind of like the parking situation. So honestly, like in general, if we can find a 3,000 square foot house on a corner lot, like 90% of the time that works. And I'm like in negotiations with a contract right now. We're coming in right at asking. We're waiving commissions. Like it's a great deal for the seller. We're still going to cash flow probably like $3,000 a month on this one, and the cash on that is probably like 15-20%. And so like we don't care to like try to get the best possible deal and like, for lack of a better word, like screw over the seller. Whatever, give them what they want. We're still getting a great deal, and it can be like this win-win, everyone's happy kind of thing, at least for now. Not that to be said, like we'll still try to find good deals, and my first offer was below listing, and we'll try to get what we can, but we're not going to let a deal go over like 20, 30 grand.
Not when you're cash flowing at double market rates, right?
Yeah, I mean the numbers like we're $100 instead of cash flowing $3,200, we're cash flowing $3,150 or $3,000, whatever. But like the numbers are so, it doesn't matter. Like that's kind of how we look at it.
Alan, picking partners, especially when you are looking to scale, is super important. Now you have, I think, kind of a funny story on picking maybe the wrong partners. There are only 2 of you now. There were 3, right?
Yeah, when we started, there were 3 of us. So as I looked at this opportunity, I didn't want to be the capital raising guy. I wanted to be the systems and scaling guy and building the team. And so I invited my youngest brother to be a part of the initial partnership. And
nothing's ever gone wrong by hiring your family members, right?
Yeah, it usually goes.
Sounds good.
Yeah, we're off to a great start, right? His background, he'd been in tech sales for 15 or 20 years and very successful. He was and is a great salesperson. And I liked the fact that he had connections into that tech world, which to me opened up other avenues for investment that were easy to reach. My network was more in small business owners, or I'm a pilot, so connections with other pilots. And from the beginning, that looked really good. as we started, there just were several instances where, you know, it'd be 7 o'clock at night and I'm wrapping up a meeting with a potential investor, or, you know, working on something, and I'd call him and, you know, hey, were you able to get this done? Dude, it's 7 o'clock. I was done at 5. And I didn't appreciate, because I've always been an entrepreneur, I didn't appreciate the gap in mindset that was for him. And then, you know, it became evident right away that this just wasn't going to work long term. We needed somebody that could run with us, especially at the beginning. And, you know, so then it was, how do I navigate maintaining a relationship with my brother and also doing what's best for our business, for my other partner, Christian, and for our investors. And ultimately what that came down to is it goes back to the same question you asked before. When things aren't going right, how do you handle it? And in the gap, as I was listening to these guys, an aviation analogy came to mind. Is when you have an emergency in the air, they tell you to do 3 things. You aviate, communicate, and then you navigate. And so first thing, you have to fly the airplane. So we had to figure out, how do we keep the business running while we figure out this problem? Don't cause an additional emergency by crashing the plane while you're trying to solve the original emergency. The next thing is to communicate. And so for me, it became I didn't rush into the conversation, and ultimately what I realized is I was responsible for where we were. I had invited him into this partnership. I had made assumptions and expectations of him that weren't realistic and weren't really in line with his experience. They were in line with my desires for him. And that wasn't his fault, that was my fault. And same way, if you're having trouble in a deal with an investor, it's not their fault that you're there. You know, they trusted you. And so you just have to take responsibility. And so when I sat down with him, I said, hey, I've made a mistake, and I want to do what I can do to rectify the situation. No matter what happens in this conversation, the end result is there's going to be a change in our partnership. So that is the outcome we're headed towards. But here's how I want to navigate this with you, is because it was my mistake, I'm going to let you set the terms of the exit. So what we're going to do is you decide what your shares in our business are worth, and then I'll decide if I'm buying you out or you're buying me out. And what that did is it removed the question of what is he worth, and it was just what is the thing worth. If he wanted to own the whole company, he could buy us out for the price that he selected. It turned out the other way, where he set a price and we were like, okay. It was more than what it was worth right then, but I knew it was a lot less than what it was going to be worth over time. And we still have a great relationship. It's the best relationship I have with any of my siblings, but it could have gone completely the other direction.
Wow. Okay, what a powerful story. And also, I didn't even know, and I think in the audience we got an extra bonus today because we got a little bit of residential niche asset classes and decided therapy, all right? We can all take ownership when something doesn't go right? All right, I think you guys, that is a wrap. Can we get a hand for these panelists? Thank you guys, you brought it.
Guys.
Thank you. All right.